Good afternoon, everyone. Thank you for joining us today. I'm Zach, the Outreach Coordinator here at the Taxpayers Help Center, and I'm excited to be here with you to talk about how IRS debt can ground your U.S. passport. Fun fact, did you know that owing the IRS can keep you from traveling abroad? Under the FAST Act of 2015, if you have seriously delinquent tax debt of over $64,000, the IRS can certify your debt to the State Department. This could result in your passport application being denied or even having your current passport revoked. So, tax troubles might not just hit your wallet, but they can also affect your travel plans. So, stick around to learn how you can avoid these unexpected travel restrictions, understand what qualifies as seriously delinquent tax debt, and find out what steps you can take if your passport is at risk. So, the Taxpayers Help Center is a nonprofit 501c3 organization in California, in Northridge, California, and we operate two tax clinics, the first of which is our low income taxpayer clinic, where we help taxpayers resolve their tax disputes with the IRS, and the second, which is our volunteer income tax assistance clinic, in which we help prepare income taxes for free. We are an IRS authorized certifying acceptance agent for individual taxpayer identification number applications. And then Isaac, I'm the outreach coordinator here at the Taxpayers Help Center, and then the clinic director is Masood Chotani. And then just before we get started, just a few housekeeping items. Please make sure your microphone is muted during the presentation so we can avoid any background noise. Feel free to use the chat if you have any questions. And if you experience any technical issues, please let us know through the chat and we'll do our best to help. So if you would like to connect with us, you may do so through email at info@taxpayershelpcenter.com, through our Facebook, which is Taxpayers Help Center Inc., a nonprofit organization. We also have our location at 9029 Reseda Boulevard, Suite 209, Northridge, California. And then our website, taxpayershelpcenter.com, and then our phone number is listed as well. And then if you have any questions at any time during the presentation, if you're not watching it live, you can email us at info@taxpayershelpcenter.com and a tax professional will get back to you. The Taxpayers Help Center helps taxpayers both locally and beyond. And since the services we provide are free, donations are important in supporting us and in helping the reach of our services. Any monetary donations are greatly appreciated, and those who can volunteer their time or expertise or spread awareness are also great help. So if you would like to make a monetary donation, you may do so at taxpayershelpcenter.com/make-a-donation. Or if you go to taxpayershelpcenter.com and click on the Make a Donation tab, then you'll be able to there as well. And again, anything is greatly appreciated as these donations allow us to do what we do. So today we're going to discuss how IRS debt can ground your U.S. passport. We'll address the following topics. What is a seriously delinquent tax debt? How the IRS refers tax debt to the State Department? What you need to know about passport revocation? Preventing IRS referral to the State Department, legal remedies, and resolution strategies. What to do if your passport is at risk, and then we'll look at some real-life case studies. First, let's talk about the FAST Act of 2015. So on December 4th, 2015, the FAST Act introduced Code Section 7345, which mandates the Department of the Treasury to inform the Department of State when an individual is certified as having a seriously delinquent tax debt. This certification or its reversal can only be made by specific IRS officials, including the Commissioner of Internal Revenue or a designated delegate. When the State Department receives such a certification under Section 7345, it generally denies the individual's passport application or issuance or renewal and may also revoke or limit an existing passport. So the IRS and State Department began enforcing these rules in January 2018. So now let's talk about the People First initiative. It was a critical policy by the IRS designed to assist taxpayers facing financial difficulties. The initiative temporarily suspended certain enforcement actions, including the certification of seriously delinquent tax debts that could lead to passport revocation. This meant that, under certain circumstances, the IRS held off on pursuing aggressive collection measures. The initiative was particularly significant during the COVID-19 pandemic, providing some taxpayers some breathing room to manage their obligations. And the goal here was to give taxpayers a chance to address their issues without immediately facing severe penalties or actions like passport revocation. So let's discuss what constitutes a seriously delinquent tax debt under the IRS guidelines. So this classification isn't just about owing a large sum of money, it's a combination of factors that show a taxpayer's failure to comply with tax rules. As of 2025, the threshold for a seriously delinquent tax debt is set at $64,000 adjusted for inflation. This amount includes not only the initial tax owed, but also any penalties and accrued interest. So a taxpayer who initially owes $45,000 could see that amount increase to over $64,000 if the debt is left unpaid and interest accumulates. To enforce compliance, the IRS may take significant actions like filing a notice of federal tax lien or issuing a levy. These steps aren't immediate, they come after multiple attempts to contact the taxpayer and resolve the issue. Several situations can trigger debt being classified as seriously delinquent. So one major trigger is a failure to file required tax returns. Imagine a taxpayer who earns income but ignores repeated IRS notices to file returns. That taxpayer could face the serious classification. Another trigger is defaulting on an installment agreement. If a taxpayer sets up a plan to pay back taxes but stops making payments without any valid reasons or communication, the IRS might escalate the situation by filing a lien. Additionally, serious underreporting of income can lead to this status. For instance, if someone fails to report substantial income, the penalties can be significant enough to push their debt into the seriously delinquent category. These examples emphasize the importance of staying compliant with tax obligations because ignoring these issues can lead to severe consequences, including the passport restrictions or enforced collections. And the IRS does provide opportunities to resolve these debts, but when these opportunities are ignored, the implications can be quite serious. How the IRS refers tax debt to the State Department. So when the IRS identifies a taxpayer as having a seriously delinquent tax debt, it doesn't just handle the issue internally. The IRS has the authority to refer this debt to the U.S. State Department, setting in motion a series of significant consequences for the taxpayer. This process starts with the IRS certifying the tax debt as seriously delinquent. This certification means that the taxpayer owes more than $64,000, I believe that should be, has exhausted most options for appeal or contest, and still has not resolved the debt. So once the IRS certifies the debt, it forwards this information to the State Department. The State Department's role in this process is crucial. It is empowered to deny, revoke, or limit a taxpayer's passport based on the IRS's certification. For example, if a taxpayer is planning to travel internationally, the State Department could deny their passport application or renewal. In more severe cases, an existing passport might be revoked, limiting the taxpayer's ability to travel outside the U.S. And the time, excuse me, the timeline of events in this process typically starts with the IRS issuing a notice of federal tax lien or levy. If these actions fail to result in payment or resolution, the IRS moves to certify the debt. Once it's certified, the IRS sends a notice to the taxpayer, usually in the form of IRS Notice CP 508C, informing them that their debt has been referred to the State Department. This notice is a final warning for taxpayers to resolve their debt before facing potential passport restrictions. The State Department is then notified and can act almost immediately depending on the taxpayer's travel status and other factors. This process can unfold quickly, leaving taxpayers with limited time to respond. However, if the taxpayer makes full payments or enters into an installment agreement, the IRS can reverse the certification and the State Department can restore their passport privileges. The key takeaway is that taxpayers must act promptly to resolve their debts once they receive notification, as the repercussions of inaction can extend beyond financial penalties to significantly impact personal freedom and mobility. Passport revocation is one of the more severe consequences of having a seriously delinquent tax debt certified by the IRS. This process is not automatic. It happens under specific conditions. The primary condition leading to a revocation is when the IRS certifies a taxpayer's debt as seriously delinquent and notifies the State Department. When this happens, as we mentioned, the State Department has the authority to revoke a current passport or deny a new application or renewal. The impact on travel ban can be far reaching and immediate. For example, if the taxpayer is already abroad and the IRS certifies their debt, they could be denied entry back into the US without a valid passport. Similarly, a taxpayer planning a trip might find their passport application or renewal denied. So, you could find yourself in a situation where you book a long-awaited vacation or an important business trip, only to find out at the last moment that your passport has been revoked or renewal denied due to unpaid taxes. And this is a real scenario for many who fall into this category. Reapplying for a passport after revocation is not as simple as resolving the debt. The taxpayer must either pay off the debt in full or enter into an acceptable payment arrangement with the IRS, such as an installment agreement or an offer in compromise. Even then, it takes time for the IRS to reverse the certification and for the State Department to lift the restrictions. There are often delays and additional challenges, including having to provide proof that the debt has been addressed or that an agreement is in place. Reapplying becomes a hurdle, and the traveler must be prepared for extensive verification processes. Overall, the takeaway is that the passport revocation due to tax debt is a significant issue that impacts more than just financial status. It is affecting your personal freedoms, international mobility, and resolving this debt quickly and understanding the process can prevent these serious consequences. Understanding your CP 504 notices. So the CP 504 notice is a serious warning from the IRS of their intent to levy your assets if a tax debt remains unpaid. Its purpose is to alert taxpayers that in addition to the potential levies on bank accounts or wages, the IRS may certify the debt to the State Department, putting your passport at risk of denial or revocation. If you receive a CP 504 notice, immediate action is required, either by paying the debt off or so either by paying the debt off or through contacting the IRS to discuss your options and avoid further escalation, such as enforced collection actions or passport restrictions. So, preventing the IRS from referring a seriously delinquent tax debt to the State Department is crucial to avoid passport issues and other severe consequences. The best way to prevent an IRS referral is to be proactive about managing tax obligations. This starts with filing all tax returns on time and responding to any IRS notices or letters promptly. Ignoring these notices can lead to an escalation where manageable tax debt turns into a seriously delinquent situation. For example, if you receive a notice about an underpayment or missing return, it's essential to address it right away rather than letting it slide, which could lead to penalties, interest, and eventually a certification of serious delinquency. If a taxpayer finds themselves owing more than they can pay immediately, the IRS offers various payment options and installment agreements. These agreements allow the taxpayer to break down their tax debt into manageable monthly payments. So one of the simplest options is the streamlined installment agreement, which requires minimal paperwork and is available for debts under a certain amount. For larger debts, taxpayers might consider an offer in compromise, which is abbreviated OIC, where they negotiate to pay less than the full amount owed. For example, someone owing $70,000 might be eligible to pay $40,000 through an OIC if they can prove financial hardship. Setting up one of these agreements prevents the IRS from certifying the debt as seriously delinquent and thus avoids referral into the State Department. So communication with the IRS plays a pivotal role in the process. Keeping an open line of communication helps in negotiating terms, understanding options, and demonstrating good faith in resolving the debt. If taxpayers communicate early, they can often prevent escalation and manage their debts in a way that avoids certification as seriously delinquent. When dealing with serious tax debt, there are seriously legal remedies and resolution strategies that taxpayers can utilize to manage their situation and avoid further escalation by the IRS. So, as we talked about, one common strategy is an offering compromise. This is an agreement between the taxpayer and the IRS that allows the taxpayer to settle their tax debt for less than the full amount owed. So for an example of this would be a taxpayer owing $100,000. They might negotiate that to pay only $50,000 if they can prove that their financial situation makes it unlikely they could ever pay the full amount. Another powerful tool for resolving tax disputes is a collection due process hearing, CDP. This hearing provides a platform for taxpayers to challenge the IRS's collection actions, such as levies or liens. During a CDP hearing, taxpayers can present their tax case, propose alternative payment arrangements, or request the IRS consider an offering compromise. For instance, if the IRS places a levy on a taxpayer's bank account, the taxpayer can request a CDP hearing to contest the levy and negotiate a more manageable payment plan. This hearing helps ensure that the IRS follows proper procedures and gives taxpayers an opportunity to resolve their tax debt without resorting to severe collection actions. For those facing tax issues due to error made by a spouse, innocent spouse relief can provide a path to resolution. This form of tax relief is available when a taxpayer can demonstrate that they should not be held liable for taxes, interest, and penalties that arise from a spouse's incorrect tax filings. For instance, if one spouse underreported income or improperly claimed deductions without the other spouse's knowledge, the innocent spouse can apply for relief to avoid being held responsible for this resulting tax debt. This remedy is particularly valuable in situations where one spouse may have acted without the knowledge or involvement of the other, creating a disproportionate financial burden. What to do if your passport is at risk? If you find out that your passport is at risk due to the certification of seriously delinquent tax debt by the IRS, it's crucial to act quickly to prevent significant disruptions to your travel plans and legal standing. So the first step involves immediate action to address the debt. So the most effective way to resolve this issue quickly is to pay off the debt in full if possible. If a full payment isn't feasible, excuse me, setting up an installment agreement with the IRS is another immediate step. This shows good faith in resolving the debt and can result in the IRS reversing the certification, which in turn, which in turn allows the State Department to restore your passport privileges. Working with the IRS and State Department is essential in this process. Once your debt is certified as seriously delinquent, you'll receive a notice from the IRS, often a CP 508C notice. Upon receiving this notice, it's important to communicate promptly with the IRS. Contact them directly to discuss your payment options or to resolve any discrepancies that may have led to the certification. After resolving a debt, request the IRS to issue a CP 508R notice, which informs the State Department that your certification has been reversed. So as we've kind of emphasized throughout this, presentation, staying in regular communication with all agencies involved is crucial to make sure that all steps are correctly followed and that your travel plans can remain intact. So if dealing with the IRS and State Department feels overwhelming, or if your case involves complex financial issues, seeking professional help is highly advisable. A tax attorney, CPA, or an enrolled agent experienced in handling tax debt cases can provide the expertise needed to navigate these waters. Professionals can negotiate on your behalf, help you understand all available options, and ensure any agreements with the IRS are set up correctly. So, for example, if you're unsure about the eligibility for offering compromise or other tax relief programs, or rather just relief programs, a tax professional can evaluate your case and advise the best course of action. They can also handle all communication with the IRS and State Department, which can make the process less overwhelming. So if you've resolved your tax debts, the IRS can issue a CP 508R notice, which reverses of the certification of your debt as seriously delinquent. So this notice is typically issued when a taxpayer makes full payment of the debt enters into an acceptable installment agreement, or otherwise meets the criteria for reversal. Once the IRS sends a notice, the IRS State Department is notified, and then they can reinstate or renew your passport. This is the final step in regaining your travel rights, but it requires that all conditions be met and verified by the IRS. So now we'll go into some real life case studies that highlight what can happen when tax debt leads to passport revocation. These examples show how high profile individuals and everyday taxpayers have been affected by this serious consequence. So let's talk about the Matson versus Commissioner of Internal Revenue. So Matson versus Commissioner of Internal Revenue has some of these key points. So the case centers around whether, well, first let's give some context actually. Let's start there. So one notable case involves a well-known business executive. He owed over $200,000 in taxes, but ignored IRS notices for years. His passport was revoked when he was about to travel abroad for a major conference. So this not only impacted his personal life, but also had significant personal repercussions, including loss of business opportunities or whatever he was doing while, whatever he planned on doing while traveling. So in another case, we have a freelance contractor who didn't file tax returns for several years, leading to an accumulation of $75,000 in tax debt. He received multiple notices from the IRS but failed to respond. So eventually his debt was certified as seriously delinquent, and when he tried to renew his passport for an important trip, his application was denied. This situation could have been avoided if he had taken the steps earlier to address the debt. So let's go to the Matson versus Commissioner of Internal Revenue. So this case centers around when the IRS or whether the IRS properly certified Eric Matson's tax debt as seriously delinquent, a classification that can lead to passport revocation under U.S. Code 7345. So in the application of the rule, Matson challenged the IRS's actions, claiming they didn't follow the correct procedures. However, the court found that his tax debt far exceeds the statutory limit, and all proper procedures, including notices and opportunities for appeal, were provided. The IRS presented clear evidence of compliance, showing that the certification was in line with the statute's purpose, which is to motivate taxpayers to resolve their tax debts. So the court sided with the IRS, upholding the certification of Matson's debt as seriously delinquent. This decision means that Matson's passport could be revoked as his debt status meets the criteria under Section 7345. Now let's talk about Nye versus the Commissioner of the Internal Revenue. This case similarly explores the issue of passport revocation due to seriously delinquent tax debt. The key question here is whether the IRS correctly certified Daniel Olin Nye's debt under Section 7345. The rule under Section 7345 is that a taxpayer can be certified as having a seriously delinquent tax debt if their assessed federal tax liability exceeds $64,000, is unpaid, and is legally enforceable. So in the application of this rule, Nye's tax debt reached $99,222, covering multiple years and involving several notices of federal tax lien and intent to levy. Nye argued that he complied with his installment agreement, but the court found that he failed to provide updated financial statements and did not meet the term requirements. Despite his claims, there's no evidence to back up his compliance, and so again, the court granted summary judgment in favor of the IRS. So let's just have a quick recap here. So understanding and managing seriously delinquent tax debt is really important. It's important to be proactive. File your taxes, respond to the IRS, and set up payment plans. And then if these issues come up, it's important to use legal remedies, offers in compromise, collections, due process hearings, innocent spouse relief. But the best thing to do is always just pay off your debt if possible. So that is all for today. Thank you all for listening. And again, since our services are free, donations are crucial for our support and expanding our reach. Monetary donations are greatly appreciated, and additionally, those who can volunteer their time, expertise to help spread awareness are a great help. So if you had any questions about anything during the presentation, please email us at info@taxpayershelpcenter.com and your questions will be answered by a tax professional. So with that being said, thank you all for listening and have a great day.